Who hasn't heard of Warren Buffett, one of the world's richest people, consistently ranking high in Forbes' list of billionaires? His net worth was listed at $100 billion as of June 2022. He is probably best known for being one of the world's most successful investors. This is why it's not surprising that Warren Buffett's investment strategy has reached mythical proportions. Buffett follows several important tenets and an investment philosophy that's widely followed around the globe. So just what are the secrets to his success? If you want to know the answer, make sure to watch the video till the end. 1. Company performance. Sometimes return on equity, or ROE, is referred to as the stockholders' return on investment. It reveals the rate at which shareholders earn income on their shares. Buffett always looks at ROE to see whether a company has consistently performed well compared to other companies in the same industry. ROE is calculated as follows. ROE equals net income divided by shareholders' equity. Looking at the ROE in just the last year isn't enough. The investor should view the ROE from the past 5 to 10 years to analyze historical performance. 2. Company debt. The debt-to-equity ratio, or DE, is another key characteristic Buffett considers carefully. Buffett prefers to see a small amount of debt so that earnings growth is being generated from shareholders' equity as opposed to borrowed money. The DE ratio is calculated as follows. Debt-to-equity ratio equals total liabilities divided by shareholders' equity. This ratio shows the proportion of equity and debt the company uses to finance its assets, and the higher the ratio, the more debt, rather than equity, is financing the company. A high debt level compared to equity can result in volatile earnings and large interest expenses. For a more stringent test, investors sometimes use only long-term debt instead of total liabilities in the calculation above. 3. Profit margins. A company's profitability depends not only on having a good profit margin, but also on consistently increasing it. This margin is calculated by dividing net income by net sales. For a good indication of historical profit margins, investors should look back at least 5 years. A high profit margin indicates the company is executing its business well, but increasing margins mean management has been extremely efficient and successful at controlling expenses. 4. Is the company public? Buffett typically considers only companies that have been around for at least 10 years. As a result, most of the technology companies that have had their initial public offering or IPO in the past decade wouldn't get on Buffett's radar. He said he doesn't understand the mechanics behind many of today's technology companies and only invests in a business that he fully understands. Never underestimate the value of historical performance. This demonstrates the company's ability or inability to increase shareholder value. Do keep in mind, however, that a stock's past performance doesn't guarantee future performance. The value investor's job is to determine how well the company can perform in the future. Determining this is inherently tricky, but evidently, Buffett is very good at it. 5. Commodity reliance. You might initially think of this question as a radical approach to narrowing down a company. Buffett, however, sees this question as an important one. He tends to shy away, but not always, from companies whose products are indistinguishable from those of competitors and those that rely solely on a commodity such as oil and gas. If the company doesn't offer anything different from another firm within the same industry, Buffett sees little that sets the company apart. Any characteristic that is hard to replicate is what Buffett calls a company's economic moat or a competitive advantage. The wider the moat, the tougher it is for a competitor to gain market share. 6. Is it cheap? This is the kicker. Finding companies that meet the other 5 criteria is one thing, but determining whether they're undervalued is the most difficult part of value investing, and it's Buffett's most important skill. To check this, an investor must determine a company's intrinsic value by analyzing a number of business fundamentals including earnings, revenues, and assets. And a company's intrinsic value is usually higher than its liquidation value, which is what a company would be worth if it were broken up and sold today. The liquidation value does include intangibles such as the value of a brand name, which is not directly stated on the financial statements. Once Buffett determines the intrinsic value of the company as a whole, he compares it to its current market capitalization, the current total worth of price. That was it for today. Sounds easy, doesn't it? Well, Buffett's success, however, depends on his unmatched skill in accurately determining this intrinsic value. While we can outline some of his criteria, we have no way of knowing exactly how he gained such precise mastery of calculating value. Share this video with a friend if you found it useful. Consider subscribing to the channel for more videos about investing, business, stock market, managing money, building wealth, passive income, and other finance-related content about Warren Buffett.